Canadians navigating cross-border home buying in the US. What are your options? Well, you're either going to pay cash or you're going to get financing. If you have the cash, congratulations. But there's some things that you should know before making that decision. If you do not have the cash or you prefer not to use the cash, then financing is the way to go. And yes, Canadians can qualify for financing. So today I'm going to share my experiences, some tips before you actually look at getting that financing intact, as well as some pros and cons to paying cash versus financing for a property in the US. Hi, I'm Brenda Jackson, otherwise known as B. I'm in my 50s with a lot of life experience. I am a retired certified financial planner of 30 years, and I'm here to share my experiences and my expertise with you. So whether you are buying a house for a principal residence or a secondary home for a vacation or retirement home, there's certain rules that you should know about residency, taxes, and healthcare. So I'm not going to be discussing that today. That's going to be for another video. So if you'd like to subscribe so you don't miss out on it, please do. But those are things that you should know. We're just going to be talking about the simplified, either paying cash or financing a house in the US. So let's get started here. So your mind is made up that this is what you're going to do. So let's get you prepared, because your Canadian credit history is not recognized in the US. So these are the things that I'm going to suggest that you do at the very beginning. If you have a Canadian American Express card, there's a global transfer program that you're able to apply for American Express US denomination card that they'll use your Canadian credentials. It's not going to help your credit rating right off the bat, but it's going to simplify it when you transition to the US. Trust me on this. If you don't have that, there's other alternatives, or you can do both of these. Look for a Canadian bank that offers cross-border banking. So in the instance, I ended up using the RBC. So the RBC cross-border banking, it allows you to have a Canadian account, a US account, and as well as a US visa if you qualify for it. So I suggest that you do exactly that. It makes the transition and transferring money back and forth to Canadian to the US simplified. Whether you use the bank's rate or use Knightbridge, which is a company that we use that provides a better rate. I will provide the link down below as well. But it also gives you that freedom that you can do everything under one roof as you get started. They also have a cross-border mortgage department. But let's go back to the US visa. Start using that US visa when you travel. It's not going to start your credit rating history started in the US, because you need to have a residence and you need to either have a social security number or a tax identification number, a TIN number. But once you have those requirements, you can send a W-9 form that is through the website of the IRS, which I'll have down below. You submit it to that bank's tax department. That bank tax department will then send it to the credit bureaus in the US, and it will actually backdate your history to the time that credit card was issued. That is going to be key for you, either before you buy a house, for buying a house, or making a big purchase later on, such as a vehicle. So now we have that done. Now let's find, you found a house, you're looking at houses. You can get a pre-approval certificate through the cross-border mortgage department. You need to show that certificate to the realtor to show them that you're eligible to buy a house in the US. Some states require it, some states don't, but it's better to be prepared. Now, keep in mind that pre-approval, for my case at RBC, was 120 days. So you had 120 days to find a house and close it. If you did not fall within that 120 days, then your interest rate would change. Now, if you are in a rush to buy a house, this product is not for you because it takes 45 days to close. And the flexibility there is not as much as if you were using a local lender. Now let's go back to the mortgage details for the cross-border banking at RBC. They have what you call ARM, adjustable rate mortgages. And how it works is that you lock your mortgage in for a set period of interest, and then after that full year, it will start to increase if you don't renegotiate it. So it's called, for example, ours was a 7/6 ARM, lock it in for 6 years, and interest rates start to go up at 7 years if interest rates are higher. Now, this is just a stepping block. There's no penalty to get out of that mortgage. So it could be to our advantage to change later, but it's just a stepping stone because they do use your credit history. They use your credit history and your Canadian income from Canada. So it's very simplified to go through the cross-border. Now, we also got a pre-approval on the US side as well. And again, they don't have your credit history, so they're not using your credit score. But they're going based on assets, liabilities, and sometimes they will give you a preferred rate if you transfer your assets to them. But again, you have to be aware because of the denomination, the exchange. You also have to be aware if they are the company that you want to deal with. Also, they may end up having you pay down an interest rate. And that amount could be $10,000, $20,000, $30,000. So you have to be aware because interest rates are going to be higher on their mortgages because they lock in their rates for 30 years. So it's not just amortized over 30 years, it's 30 years. And again, there's no penalty for getting out of that mortgage. So you have some flexibilities. The bottom line is just getting the property, start out somewhere that's going to best suit you, talk to your certified financial planner, and figure what is the best option for you. Let's talk about the pros and cons. So let's talk on the mortgages because we're already talking about the mortgages. So let's look at the pros. So the pros are that you have liquidity, you have other cash that's meant for emergencies. You're not putting it all into the property. You also have tax deduction potential because the US mortgages are, in many cases, the interest rate is tax deductible. You can also hedge against the exchange. So if the exchange is horrible, which it is right now, then you're not putting and exchanging money. You're just doing what you need to. Now, on the cons, of course, the application process is a little bit stressed out. It's overwhelming at times. So just be prepared for that. And you will also end up paying an interest rate, and the interest rate may be higher. And that will be the duration of the mortgage. So the cost will be higher. And if you're making a monthly payment and you have Canadian income coming in, the exchange can also go against you at that point too. So now let's look at cash. So the cash, of course, it's simple, it's fast, easy peasy. And most people that are selling their properties prefer cash deals because it's clean, it's simplified. So you might even have more negotiating power. And also the exchange could work in your benefit, especially if the dollar is high. A few years ago when it was at par, it was perfect. Well, right now it's not the time, but that's just an example of how it could be beneficial to you. Now let's look at the cons. Well, if you have too much money being tied up in a property, you don't have the liquidity and you do not have the emergency money that might be required. You also might be losing on the potential of the tax savings on the interest rate that you, again, in the US, you're able to deduct your mortgage interest rate. And the exchange can work against you as well. So there you have it, folks. I hope this was informative for you. Again, strongly advise your personal financial advisor to assist you here. If you found this useful, please subscribe for further videos, and I look forward to connecting with you. If you have any questions or comments, feel free to have them below. Happy house hunting.